First, I just want to say, I told Rick he could only go through the buffet line 3 times, so if anybody didn't get enough to eat, you know where the fault squarely lies. But we didn't want anybody to overeat for dinner tonight. It's going to be fantastic at the Barns. So in terms of a couple of things for dinner tonight, it's at the Barnes Foundation. The buses depart the Inn at Penn on the Walnut Street entrance at 6:30 and 6:45, so there are a number of buses that will pick everybody up. I will say, if you like to walk, it's perfectly walkable. It's about a 40-minute walk, 45-minute walk. You come out of your hotel, you take a left on Walnut Street, you walk down to 20th Street, you take a left on 20th Street, it takes you right to the Barnes Foundation. So it's basically an L. It's very walkable, and as you see, it's a beautiful thing out there. And it's perfectly safe the whole way. There's no issue there. The reception in the art gallery open from 7 to 8, so there'll be drinks and snacks and things. No food or beverages can go into the art gallery part, so it has to stay in the reception area. Dinner will be at 8 o'clock. In your folders, there is your meal choice. So there's a little card that has your meal choice. Please do bring that with you. Put it on the table when you sit. They'll need that so you know what's there. And then the other thing I want to know, just mainly so you can tell any colleagues, PhD students, whatever, is that all the sessions are being recorded, video recorded, and the recordings will all be posted to our conference website. So if anybody feels like they want to see one of the presentations, they can do that. Okay. Take it away. Yeah.
Okay, so we have Seil Kim is going to be presenting his paper with Sehwa and Shiva on insider trading, and after he gives the presentation, then we'll have Robert Jackson, NYU law professor and former SEC discuss the paper, and then we'll do questions. The floor is yours.
Thank you. On behalf of our team, Sehwa and Shiva, we'd first like to thank Wayne Gui, our editor, for giving us a chance to present this paper, and also Rob Jackson for taking the time to discuss our paper. So we're looking at a recent regulatory change at the SEC regarding insider trading. Our paper is fairly descriptive, so given my 20 minutes, I'd like to get everyone on the same page about the institutional details, what changed due to the regulation, and how it affected insider trading. So first about Rule 10b5-1. What's Rule 10b5-1? So U.S. executives and insiders get compensated a lot with stock, so they do need to unload them from time to time. But U.S. being a litigious country, these insiders also get sued a lot. So when they sell stock and the stock price drops, they can get sued with shareholders alleging that insiders are selling the stock while in possession of material non-public information and not disclosing that to the investors. So what happened in 2000 at the SEC was they made Rule 10b5-1, which allowed insiders to sell the stocks without being accused of illegal insider trading. So how it would work is you set up a pre-arranged trading plan while not in possession of non-public information. Practically, how it would typically work is that you write down a plan or formula of when and how you want to unload your shares. You send those instructions to the broker, and the broker sells the shares later on. A formula could look something like this. So it says, sell 1,000 shares on the first day of each month. So this formula looks fairly innocent, but it can also be abused in the following few ways. For example, if this plan was set at the last day of the previous month, then you'd be selling pretty quickly after setting up the plan. Starts to look a little bit more suspicious. Or you could also set up this plan, and as you get closer to the date of the sale, you could see where the stock is going. And if the stock's going down, maybe you just let the plan go through. If you think the stock's going to go further up, maybe you cancel the plan, and so you can sell the shares later at a higher price. So that's another way you could abuse it. Another way you could abuse it is to influence the timing of the news. So set up the plan as you get closer to the date of the sale. You might delay bad news disclosure, or you could put out some good news so that you can sell at the peak of the stock price. So I want to share with you one example of how it was abused. So here's on-track CEO Pfizer. So on August 13, 2021, he learns that the company, it's a pharmaceutical company, is losing its major customer. And what he does, he calls up his broker and says, I want to unload my shares. And the broker, being a reputable one, says, we have internal rules. We need 30 days in advance of notice, a cooling off period before you start unloading your shares. CEO says, can you do better? And the broker says, we can go down to 14 days. So he eventually finds a less ethical broker who says, we can start selling as soon as you want. So on August 16th, he starts selling his shares, 90,000 shares. And eventually the news comes out that the company has lost its major customer. Even the CEO, I guess, could not delay this bad information. But because he started selling well in advance, he saves millions of dollars by avoiding losses. So how do we know this? Because this eventually became a lawsuit, and so we know about the cost to the brokers and that. But how do we know about the insider trades? Because those are reported in something called the Form 4 that's filed with the SEC. So this was the Form 4 that he filed regarding these trades. And this is also the basis of where our data comes from. So August 16, 2021, he's selling 15,000 shares daily throughout the following days. And more importantly, in the footnote to the Form 4, they say it's based on a Rule 10b5 trading plan that was set August 13, 2021. So this is also where we get the data about whether this trading was based on 10b5-1 or outside of 10b5-1 trading plans. So when you look at this, you might think, why is he confessing, right? So that's kind of in hindsight when you look at this and see that the plan was set pretty close to when the sales started happening. But my impression is he actually voluntarily put this information here because he thought it was a better legal defense when you put that these sales were pre-planned instead of outside of these 10b5-1 trading plans. So it was actually like that. So U.S. versus Pfizer was the first criminal case solely based on 10b5-1 trades. And in civil cases where shareholders sued, trades made under Rule 10b5-1 plans have generally not been deemed suspicious. So actually, if you do put that in the footnotes to the Form 4s, I think you do actually get some more legal defense. There were only a few cases we could find where the 10b5-1 defense was not effective. So I guess in looking at this, you might think, why didn't everyone do 10b5-1 if it was such a great defense? But I guess you can maybe think of all the other tensions. There's like issues of flexibility, or sometimes even having the 10b5-1s are not actually effective, or there could be also corporate internal policies against or for using 10b5-1 plans. So in reality, there's about a half and half, 50-50 split. So about 50% of the sales go through under a plan, 50% are outside of those plans. Okay, so SEC identifying these kind of loopholes in the original 10b5-1 rule amended the rule with these 5 major changes. So first, they applied a 90-day cooling off period. So you can no longer do set up the plan and start selling pretty soon. You have to wait 90 days for the first sales to go out. And number 2 and 3, prohibition on overlapping plans and limitations on single trade plans. This basically limits setting up multiple plans and canceling as you go. So that has been limited now. Director and officer certification, so kind of like SOX, the insiders have to certify that they didn't have material non-public information when they set up the plan. And there's also enhanced disclosure requirements. Companies now have to disclose the adoption, modification, termination of 10b5-1 plans and insider trading policy. So I'll show you some examples of how the enhanced disclosure requirements work, and because that's also part of our data. So these are kind of the new Form 4s that you'll see. And on the upper left-hand corner, there's now a checkbox where if this trade is based on a 10b5-1 plan, you have to check the box. And now this is a mandatory disclosure. In addition to that, the SEC said we want to know when the plan was adopted. But unlike the checkbox, they didn't provide a place to write it down. So we showed this in the online appendix, so not everyone does this. But also, this has become mandatory disclosure that you have to show when the plan was adopted. So this is a change to the Form 4. Another change is there's a new section in the 10Q, 10Ks. So if there were adoptions, modifications, or terminations of 10b5-1 plans during the previous quarter, they have to disclose it here. So this is Palo Alto Networks. And here in this quarter, 3 of their insiders adopted a new plan. 1 insider terminated a plan. And through this disclosure, I think the SEC's intention was that investors get informed about the changes to these plans. And also there's sort of like this monitoring mechanism. So because this is disclosed, insiders might not want to mess around like having a lot of changes to their plans. But there are some downsides, perhaps. It's disclosed with delay because it's reported in a 10Q, not instantly. And also there's no information on when or how shares will be sold. As you can see, this is the full disclosure. All you have is the date of the adoption of the plan, expiration date of the plan, and how many shares they want to sell. There's no information about like what kind of formula on when or how much of the shares they're going to actually sell. I wish I could have access to that data. We don't have that. So those are the additional disclosures. So based on that data, what we want to do in this paper is basically see, did the rule work? And we're going to look at 3 major things. First, we look at the compliance with the 90-day cooling off period. Second, if they do comply, there must be some compliance costs. Perhaps maybe they shift from a 10b5-1 to trading outside of the 10b5-1 defense afterwards. So that's our second question. Third, we look at, does the amendment limit the opportunistic use of 10b5-1 plans by looking at returns to insider trades and also whether sales are made before disappointing earnings announcements. We want it to be comprehensive. There's other provisions within the rule. For example, we're going to talk about the disclosure of terminations of 10b5-1 plans. There's other provisions that I don't think I'll have time to go over in the presentation, but I'd love your comments about. We're going to also look at timely disclosure for insider stock gifts and disclosure of option grants made around material news events. Our sample and data comes from fairly conventional places. Insider trading data from the SEC DARA. In this study, we only focus on sales because for purchases, you don't really get sued. Probably because of that reason, you don't typically have 10b5-1 plans to purchase stock. So we're only going to focus on sales, which is also conventional in the literature. And we focus on officers and directors. The rule was targeted at officers and directors and leaving out or putting less stringent rules on the 10% holders, who probably don't have constant access to private information, as do officers and directors. So I mentioned where we get the data from, and other databases that we use also fairly conventional. Looking at the Rule 10b5 amendment timeline, I also want to explain how we set up our research design. So September 2020, former Commissioner Chair Clayton wrote a letter calling for a cooling off period mandate. And after this letter, there were some, scandalous insider sales by COVID vaccine makers. And the executives of those companies sold stock at a very opportune time when the vaccines were successfully developed. And those were under 10b5-1 plans, but people were suspicious about whether it was maybe too well-timed. And then there came out a report by Larker et al., which Dan Taylor was also on that. And they also showed evidence of abuse of 10b5-1 plans. And then there was, more like a political momentum that led to all these rulemaking about changes to 10b5-1. And finally, the rule was effective on February 27th of 2023. So in our research design, it's very simple. We're doing a basic diff, comparing the pre-amendment period, post-amendment period, and probably just covering the 4 years of the Biden administration. There's one kind of caveat I want to point out before moving on. So the U.S. versus Pfizer case was announced right after the effective date of the amendment on March 1st, 2023. So it's a confounding factor. So one could argue that the results are driven by, not by the regulation, but perhaps by the enforcement effects of the U.S. versus Pfizer case. I'll try to show you some evidence that our results are more consistent with the effect of the regulation having those changes on our results, but it's a caveat that we acknowledge. Okay. So our first results, we look at compliance with the cooling off period provision. And so you can see in the pre-period, it was fairly common to sell your shares under a 10b5-1 plan pretty soon after adoption. So under 90 days, you had about 30% of the 10b5-1 sales. And you have pretty strong compliance right after the effective date, so close to full compliance. We also show the same thing, looking at bins of 30 days, the length of the cooling off period. So the bars in white are the pre-period, bars in black are the post-period. So you can see that the short cooling off period bars are shifting toward the longer cooling off period bars, but most focused, most concentrated in the 90 to 120 days. So it shows strong compliance, but I think it also shows there's compliance costs. Insiders really want to unload their shares, and so they don't want to wait too much. They want to sell as soon as they can. We show the same results just in a regression framework. So about 28 percentage points decrease in short cooling off period sales under 10b5-1 plans. So after showing you some compliance costs, we move on to see if there's a lot of migration from 10b5 to non-10b5, perhaps due to the compliance cost. We see some decrease in the use of 10b5-1 sales. Here, the plot isn't as clear. In the regression framework, we see a small decrease in the use of 10b5-1 plans. This number, we think, is a lower bound because in the pre-period, the disclosure of 10b5-1 plans in the Form 4s were voluntary, as I showed you. Now it's become mandatory, so we think this is a lower bound. Okay, moving on to the returns analysis. So here we're trying to look at whether the 10b5-1 sales have become less opportunistic. So in the pre-period, it's in black. There used to be some level of loss avoidance. Now in the post-period in red, there's less loss avoidance. And where does this change come from? So this is only looking at the pre-period trades. So the under 90 days in black with short cooling off periods, you see a much bigger loss avoidance. It's much smaller in the over 90 days. So as we get rid of this black line, I guess we get closer from the pre-period to the post-period. So that's kind of our way of showing the mechanism that the 90-day cooling off period is leading to less loss avoidance. We see some evidence of less loss avoidance for also non-10b5-1 trades. Perhaps this is an effect of the overall kind of chilling effect from enforcement. We're going to use this as our control group. So in our regressional analysis, looking at 30 to 180-day returns and also looking at whether sales are less likely to be made under before earnings or disappointing earnings, we show that there's less loss avoidance, less likely to sell before disappointing earnings in the post-period. We do see some of that pattern also for non-10b5-1 trades, but in our diff and diff framework, we see that the effects are much more stronger for the 10b5-1s. So we also look into cross-sectional analysis, focusing on potential abusers. These are people who used to sell under 90 days in 10b5-1s. Those are likely to be most affected by the rule. So they reduce the use of 10b5-1 sales. And we see that there's a small effect of these potential abusers shifting their opportunistic trades to non-10b5-1s. Moving on to potential cost to price efficiency. So whenever you think about insider trading, there's goods and bads. So insider trading may also increase price efficiency if you have insiders incorporating news into the price. So we look at our measure of price efficiency, we acknowledge that there's no perfect measure, but we're looking at variance ratios. And the idea behind looking at variance ratios is that if you have a perfectly efficient market, the stock market variance, whether you measure it with short-term intervals or long-term intervals, should be the same. Whereas if you have positive correlation or negative correlation, then you start deviating from a ratio of 1. So we look at the companies that are most affected by the rule, the companies that had more potential abusers. And for those companies, the policy would have had stronger effect. We find that their variance ratios goes up, meaning less stock market efficiency. So presumably this is like a disadvantage of the rule, perhaps, that as you have less insider trading, the prices have become more inefficient. Lastly, I want to talk about 10b5-1 terminations. So the amendment requires the disclosure of terminations in 10Q, 10K filings. And so because this is a mandate for the post period, we only have data about the post period. We look at how the stock returns move around the terminations. So when you look at the termination date, the stock return pattern around it is that as stock prices start going up, it seems like the insiders decide that maybe the stock is on its way up. I want to sell high later on, so maybe they cancel, and the stock goes up further. So maybe this is also a loophole that hasn't been fully closed, that insiders still terminate plans, perhaps to avoid selling low. So to conclude, we look at whether the amendment achieved its primary objective, and our kind of basic answer is yes. There's strong compliance with the cooling off period mandate. 10b5-1 sales are less effective in avoiding losses and less likely to occur before earnings misses. There are some negative consequences. There's a small decrease in the use of 10b5-1 plans, maybe perhaps due to compliance cost. There's evidence of opportunistic trades in non-10b5-1 sales, decline in price efficiency for highly affected firms. We also find, regarding other provisions of the rule, that the terminations still appear opportunistic, perhaps due to disclosure delay. There's a decrease in stock gift backdating and less option granting around information-sensitive events. I'll refer to the paper regarding these results. Thank you for your attention, and look forward to your comments. Thank you. Okay.
Well, thanks so much. I'm delighted to have the opportunity to comment on this terrific new paper. I thought I could begin with a quick introduction of who I am and why I'm interested in the subject, and then offer a few thoughts on the paper, and then leave, of course, as the conference organizers explain, time for questions. Sound good? Okay, so first of all, I have to ask you for forgiveness. I'm not an accountant. I know some. I've worked with accountants over the years, but I'm not an accountant. Instead, I'm Rob Jackson. I was a commissioner on the Securities and Exchange Commission during part of this period that is studied in the paper. And now I teach at NYU Law, where my work focuses on empirical study of corporate governance and finance. It's really a privilege for me to be here. I was really excited to get invited to the conference. I want to thank Wei and the authors of the paper for giving a non-accountant lawyer a chance to talk about these issues. And if you take anything away from my comments, other than we shouldn't invite lawyers anymore, I want you to take away that this kind of cross-disciplinary work can have real policy impact. Because the story I'm going to tell you is going to be a story of why the law changed, why the practices on these kinds of trades changed because of academic work like yours. And I hope you'll come away from the talk with a sense that if you want to have that kind of impact, you can. That's my goal, to prove that to you in the next 20 minutes. I was a commissioner under the first Trump administration. As you may have heard, we're having another. I was unanimously confirmed by the Senate a political independent when I was confirmed, as was my colleague Jay Clayton, who was the chair. And I played a behind-the-scenes role in the development of these changes to 10b5-1 plans. You'll hear more about that shortly. First, you might want to know, where do SEC rules come from? What determines what goes on the SEC's agenda? And the answer is political appointees like me and Jay Clayton, appointed by the president and confirmed by the Senate. We try to set out an agenda for what the SEC's rules will look like. And the way an SEC rule proceeds is through a proposal to the public of a new rule proposal like this one. And then there's a period during which commenters can offer comments and analysis. And by the way, that's an important place where academics, I wish, would spend more time. Because as a commissioner, I can tell you, when I saw a comment letter that said, we've done an empirical study on this, and we're not sure that the premises of the rule are correct, that really got my attention. And in fact, such a comment is required by law to have a response before the SEC can file the rule. Finalize the rule. So that's a key way in which all of you can influence SEC rulemaking. By the way, here's a fun note. Did you know you can petition the SEC to make rules?
No. You shouldn't have said anything.
You should. I mean, I'm petitioning them all the time. Maybe I'll petition them this afternoon. You should petition the SEC for rulemaking if you have thoughts along those lines. And indeed, I have, among others, filed a petition at the SEC. And I want to just be real transparent with you. If there's anything else you hear from my talk today, I'm not here to tell you that politics doesn't influence SEC rules or that lobbyists don't have a view about all this stuff. They do, and they do. But I want to be clear that the kind of things that you work on in the main are going to be the kinds of things that can be done on a nonpartisan basis, like this rule was. The rule change that's being studied in this paper was adopted by a 5-0 vote of the commission, a unanimous vote on a bipartisan basis. Because, frankly, not everybody, politics isn't as focused, believe it or not, on 10b5-1 rule plans as it could be. So I want to urge you that the kind of impact academics can have can also be nonpartisan. And as you may have noticed, we could use a little more of that in Washington these days. Okay. This case study I'm going to give you of how we got to changes in Rule 10b5-1 is, to my mind, the quintessential example of how academics can change the law and the work of companies that have to obey it. First of all, this is an area where there has been foundational work for years on 10b5-1 rule plans and how they can be used. You might remember Jagged Linzer had a terrific management science piece in 2009. He actually made the mistake of co-authoring with a law professor, Todd Henderson, in a law journal, believe it or not, on the subject of what might be done. And over the years, many news stories identified alleged abuses in Rule 10b5-1 plans, in part based on the kinds of empirical work that Alan Jagelinzer had done in 2009, that his journalists knew what to look for because he pointed the way. And so over time, the prospect of abuses of these plans became top of mind for regulators like me and lawyers who were thinking about these problems. Now, what I want to do is tell you the behind-the-scenes, untold story of how that kind of academic work and news public concern bubbled up into an actual SEC rule. Before I got to office, the SEC rules did not require disclosure of whether or not a stock sale was made pursuant to a 10b5-1 plan. It also didn't even require disclosure of the plan. That is, you didn't even have to say, hey, this is a trade under a 10b5-1 plan. That obviously raises an endogeneity problem. Some people voluntarily disclose, but they might have a reason for that. Others choose not to disclose. They might have a reason for that. And there was really no way to know what features of the 10b5-1 plans might be used to abuse them. And then, and here's the behind-the-scenes story, I had a meeting. When I was at the SEC, I got an email from this crazy guy, Dan Taylor, at Wharton. No, he's here. That's awkward. I got this email, and he said, the SEC has been getting a crucial form 144, in paper rather than electronically. Over 100,000 paper filings with this important detail, because Form 144s have information about the design of the 10b5-1 plans for reasons we can talk about in the Q&A if you like. All this detail is sitting in the basement with like 100,000 paper filings. And I said, why don't you come in and talk I got his email. I said, why don't you come in and talk to me? I had academics come in about once a week to present papers or ideas. And he comes in and he says, Commissioner, my first question for you is, Are you aware of what's going on with Form 144? I have a confession I want to make to you now. I didn't know what a Form 144 was. I don't know if this ever happens to you with your students where they come in and ask a question that you're supposed to know the answer to. I mean, look, I was a commissioner, but we oversaw $40 trillion. I didn't know where all the dollars were. I mean, it's kind of hard to know. So my reaction, he comes in and he says, do you understand what's going on with Form 144? And I said, why don't you tell me what you think Form 144 is? And we'll go from there. So he sits me down. He says, no, I'm telling you, Commissioner, this information, it has to be disclosed, and it's in the filings, and it's in paper downstairs. I said, wow, oh, my God. And he said, by the way, I looked at the paper, and I can see the kinds of things in 10b5-1 plans that are associated with opportunistic trading. I said, wow, that's amazing. We should go check it out. So I went down to the library, and I found he was right. This is the paper filing of the chief executive officer of Disney describing his sales on certain stocks. I mean, you could see he kind of, I think he'd be too busy for this. I mean, it's Disney, but he's like, this is Bob Iger. He signed, he said, I'm going to sell these shares pursuant to this plan. And he filed it on paper. So Taylor showed me this. And I went, then we went downstairs. This is the filing cabinet. Where all this crucial information about the structure of these 10b5-1 plans is sitting. And this is someone took a photo because they just couldn't believe this is where it was. So I went down the hall to the other commissioners, and I said, look, are you aware of what's going on with the paper filing of Form 144? You want to know what they said to me? Every one of them. Why don't you tell me what Form 144 is? And we'll go from there. Anyway, I went to Clayton and I said, look, this is crazy. He said, you're right, it is. Let's change it. And by the time Clayton's time on the commission ended, a year later, the SEC had, by a 5-0 unanimous bipartisan vote, made it electronic. That's a good way to see how impactful an academic can be. All the commissioners wanted to fix it. We just didn't know how important it was. And the same was true, you'll see in a moment, of Rule 10b5-1. You see, Taylor had come in and he said, I've got this paper with Larker, Bradford Lynch, who was then a PhD student here at Wharton, and it just points to the different red flags, the different characteristics of a plan that are associated with opportunistic trading. And he put it out in January 2021. And the basic story behind that paper, which is along the lines of a policy brief, is just to show that when there's a cooling off period, many plans had cooling off periods, but many had short cooling off periods, by which I mean the time between the adoption of the plan and the first sale under the plan was less than 60 days. That paper also shows that in those cases where there was a shorter cooling off period, following the insider sales, there were unusually negative returns after the sale. This is why I refer to these as opportunistic trades, a good time for insiders to sell quickly under these plans with short cooling off periods. And indeed, the very next year, the new chair of the SEC, Gary Gensler, gives a speech where he says, turns out this looks like a problem. We need to do something about this. And he proposed a rule to do it. The Investor Advisory Committee, which had been looking at the problem for some time, put together a proposal along the lines of the rule that we eventually got. And that rule, too, was adopted by a 5-0 bipartisan vote. Now, this chair, Gary Gensler, is that a name you've heard before? Did he seem like super popular? Yeah, so that's complicated. We could talk about that in the Q&A if you like. Please don't. But Gary had some controversial rules about climate. You might have heard, yeah? This rule adopted 5-0. You might have heard he got sued over that climate rule and was going to lose. He didn't get sued over this rule. This was a unanimously adopted rule to clean up, to restructure, using academic evidence, this long-standing rule, and was never challenged, and it was adopted on a bipartisan basis. So, this paper asks a very important question, why I'm so excited to be here to talk about it. The question it asks is, did it work? And like the authors, my basic answer is yes. Let me say a little more about that. In Figure 1b, the authors show that there was a very substantial drop in plans that had a less than 90-day cooling off period. That is, you might remember the rule mandated a longer period between the time the plans adopted and the time of the first sale under the plan. A very significant drop, the authors show us, in plans that had fewer than 90 days between those two events. And as the authors explained today, what that means is that we had pretty rapid compliance with this new set of rules. You also saw that there was a drop in the use of 10b5-1 plans. The authors characterized this as a cost, and I want to come back to that. I'm not so sure, but we'll come back to that in a minute. For now, I want to just notice that the reduction is relatively small and doesn't seem to be statistically screaming off the page. I think it's significant at what, 10%? Yeah, it doesn't seem to be jumping off the page in terms of significance. So to the degree that this happened, I'm not sure it's a cost, but I'm not also sure the evidence is super clear that we had a very substantial change in the use of 10b5-1 plans. But fundamentally, the change that we really see, and that this paper contributes to the literature, is that before the rule change, 10b5-1 based stock sales predicted negative returns over the next 180 days, and that relationship went away after the rule change. After the rule change, 10b5-1 stock sales don't forecast negative returns over the next 180 days, or the likelihood of an earnings miss. So this provides us evidence that the rule change in part achieved what it hoped to do. That is, it identified red flags, to borrow the paper's phrase, of opportunistic trading in connection with 10b5-1 plans, made those unavailable contract terms to the insiders, and the relationships that we were worried about seem to have gone away after the rule's adoption. I want to offer a couple of quick comments about interpretation of that important fact that the authors have put in the paper that I want to push them on a little bit. What they say is, overall, our findings indicate that while the amendment substantially curtailed the opportunistic use of plans, it increased the cost of 10b5-1 plans and lowered stock price efficiency. So first, I'm not sure, as I said earlier, how strong the evidence is that the cost of using a 10b5-1 plan increased. What we see is less use, at most, by the way. I'm not sure that, again, I don't think that evidence is jumping off the tables. But we see decreased use of it, but I want to back up to an institutional and legal point. Remember that all 10b5-1 plans do is give the insider a legal presumption that their trade was not on the basis of material non-public information. And to put that in a way that might be more familiar to the literature, what it means is that enforcement resources are less likely to be intensely focused on those trades as opposed to other trades. Does that make sense? Why? Because people suing on trades under 10b5-1 plans are less likely to win. Even though, as was pointed out, the government has recently gone after folks who traded under 10b5-1 plans, United States versus Pizer, and I should disclose that I was the Department of Justice's expert in the Pizer matter, and the defendant was convicted on all counts. Sorry. But what I want to say is shifting trades from 10b5-1 plans to non-10b5-1 plans, not obviously a cost. Maybe what it's doing is sorting trades from one enforcement regime to another one in a way that could be socially beneficial. Just a question for the authors to consider. Also, as a quibble, just a methodological point, I wonder about the market efficiency test they're using here. The paper focuses on the variance ratio. I say here just the ratio of A to B, that is 15-minute stock volatility to 5-minute stock volatility with some adjustment. I have to say, when I think of market efficiency, that's not the immediately intuitive measure that comes to mind for me, especially not in the context where what we're worried about is material non-public information. That is information that hasn't yet made its way into the underlying market. Instead, the way I think about that is the speed at which the market incorporates news. I had a paper with Wei Zhang in the Journal of Finance a few years ago providing some measures in that respect. And the way I would have thought about efficiency here would have been, do I see a difference in how long it takes the market to impound new information in the cases involving 10b5-1 plans or not? I would like the authors to consider looking into whether or not there's any evidence that the market response is different in different kinds of firms that they study, but it's just a suggestion. On the whole, I hope you can see, first of all, this is an important paper. I think the authors, and I'm keen to help arrange them, go to the SEC and present it to show them that the rule they adopted worked, but wasn't perfect, and maybe could be tightened, for example, with respect to plan cancellations, to give the SEC an opportunity to make evidence-based policy, hopefully more on a bipartisan basis. And also, the paper shows us that rule changes matter, that the market participants comply with changes to those rules. But most of all, I hope you can see that it shows that what you do is important. And I would just urge more of you to get folks in Washington to pay attention. File a rulemaking petition. Give a comment letter. Shoot me an email and tell me, hey, I have something I want to tell the SEC. I would love to facilitate that because I have to say, after that meeting with Taylor back in 2019, I thought to myself, that guy's crazy. But I also thought, he's right. And I bet we can fix this. Thank you again for the opportunity to comment on this terrific paper and for all the work you're doing. Let's get folks' attention in Washington, shall we? Thanks again.
Great. Can we give a couple-minute response? Let me just...
I guess I'll have to say thank you for the encouragement. I should do more research relevant to policy making, maybe. Regarding your comments, I guess, yes, we could think about other measures of market efficiency. I know it's not perfect. I don't think there is a perfect measure of market efficiency, so yeah, we could use other measures. Perhaps looking at earnings announcements. Yes, and we'll also consider whether the shift towards non-10b5-1s are actually perhaps a good thing. Yeah.
Okay, let's start with Charlie, and then Ed will be after him.
Yeah, so I guess one question I had about the market efficiency, the way you pitch it, it's like that the price is less efficient because there's less informed trading, but if you actually look, it's not a lot of money that's getting traded upon over the course of the quarter. Is the idea more like they don't, like the firm is just slower to just provide information, hoping that the 10b5 that was already like pre-scheduled is going to trade before the bad news comes out, or is it really going to be directly from like just like informed trading reducing?
What we had in mind was the latter. We didn't really think about indirect effects there, just basically having less informed insider trades so that it's less information incorporated into the prices.
Okay, because it seems like the other option's probably the more likely story, because it's not a lot of, if you look at the amount of volume across the entire quarter, whatever you're measuring, compared to the actual insider trading, it's just a tiny sliver, right?
That is true, yes. Just typically it's like maybe a couple of trades during the quarter for a company, yeah.
Okay, Ed and then Christine.
Yeah, I mean, I don't want to beat the dead horse, but I like the whole paper till I got to the efficiency measure. I mean, it makes sense in the Ringenberg paper because they're looking at trades that are dispersed across exchanges, and you can see how over a whole quarter that would affect liquidity and variance. Here, I don't get it. I didn't see how it maps in conceptually or theoretically. Rob said to look at the speed of price adjustment, which I think is something to think about. That's not as intuitive to me either. That, if we think about an earnings announcement as the revelation of information, I think what you're trying to pick up on is, was more information like triggered or leaked before based on these insider trades?
Right.
Maybe something like a jump ratio there. But frankly, I'd be hesitant to draw, I mean, if this is going to be a policy-oriented paper and take it to the SEC, I guess I would say have no result at all rather than a bad result. Right? Not bad, good, bad, but I mean, is it a poorly specified result?
Mm-hmm. Okay, thank you.
Okay, Christine and then Chloe.
Okay, so I wondered if you could talk a little about the choice to disclose in the pre-period, which is simply because your measure is different in the pre and the post.
Right.
And in your example, you mentioned that that this person thought that it would make it look better to disclose that this was part of a 10b5-1 plan. So I wondered if you have any insight into what drives that choice, and also, is it always true?
Is it always true? I guess there's no actual way for us to tell whether it's true, but I think there is an incentive to disclose on the Form 4 because prior to going into like discovery, when a lawsuit first starts, all the information that the plaintiffs have is the public Form 4. And if the Form 4 says 10b5-1, they'll think it's a weaker case, maybe we won't go after this. I think that's one kind of important reason why they want insiders would like to voluntarily put that into the Form 4. It makes a stronger case.
Can I just add a point to that? So, in a litigation, you're talking about discovery. The class period's generally measured in months or years. There's no 10b5-1 plan that's going to protect an insider in a 3-year class period in a shareholder class action lawsuit. So even if you see that, that plan wasn't put in place 3 years ago.
Right.
Even if it has a 30, 60-day cooling period, if that plan was put in effect during the class period, it makes no difference to how the litigation works, how the experts work, how they analyze insider trading. So, I know we've gone back and forth
Yes.
as editor and authors a number of times, but I still don't agree. So you guys.
Right. So I think what Wayne's mentioning is actually the other side of the argument of why even do a 10b5-1 plan if the factors that the court looks at about illegal insider trading are going to be the same. Like if you're looking at suspicious insider, atypical sized insider trading that is different from historical trading that happens during the class period, whether it's a 10b5-1 or not.
I think what these 10b5-1 plans are set up for are for the insiders are protected from specific information events coming out. So in the case that you talked about, it was a customer that they lost. I forget what the story was. It was a customer they lost. It was a short time frame. It was a trade that happened before this information was revealed about the customer. The 10b5-1 plan can be incredibly useful if you set it up properly in that context. But in general, for a shareholder class action, it's not filed because of the insider trading. It's filed because management is alleged to have withheld information about accounting information, or there are other kinds of disclosures, and it's a very large class period. So I still don't think the 10b5-1 plans are well suited to solve that problem, whereas they are for something short-term and specific information.
If I can just add to that, the suits are filed under 10b5, right? Not 20A. 20A allegations are looped in by plaintiffs' lawyers to the allegations they make in the original complaint. The court ultimately will never decide because these cases never go to trial. But the 20A, which is where which is the specific insider trading allegations, are really just looped onto the top of the general 10b5 allegation. So I think you should be really clear about that.
Okay. Thank you.
Okay, Chloe, and then Christina.
Hi. So in your empirical design, I think you kind of treat insider trading as sort of unequivocally harmful, but an insider's ability to capture these information rents can also operate as like a compensation channel. So I was curious, after the amendment tightening, do you see firms sort of increasing salaries or bonuses or granting more equity stocks? Because it would matter for the welfare takeaways of your paper, because right, one is sort of a gain and one is a transfer if you're simply forcing firms to deliver those rents in a more sort of transparent or different way.
Right. I guess in insider trading restrictions, that's another sort of unintended consequence people typically look at, in addition to, for example, what we look at for market efficiency, because if you restrict insider trading, you also restrict insiders' compensation. We haven't gone that far. Perhaps that is an effect. We could look at executive compensation. Yeah.
Okay, Christina, and then Susie.
So I promise I didn't talk to Chloe about this, but I had the same exact question. So instead of re-asking it, I will say why I think it's a good question, which is that a lot of the commenters were commenting about the pushback was that they were worried that executives wouldn't be able to liquidate their shares.
Right.
So if you could speak to whether or not the amendment went too far, which is what they were claiming it would do, then I think that would add a lot to the paper. And one good way to do that is to look descriptively at equity compensation did that change?
Makes sense. Thank you.
Okay, Susie and then Brigham.
Okay, I guess we tend to ask questions in a row.
Okay.
So yeah, I just want to echo Charlie's and Ed's comment raised earlier. So I thought your analysis on market efficiency was the most surprising part of the paper, but also a bit weak in the research design perspective. So I think in addition to ERC and maybe the jump ratio, another thing you could do is like the IPT measure, like intermediate timeliness measures, because that's exactly what you want to show. Like the stock prices are reflecting use in a more timely manner. So if you could measure that around the release of material events, whether it's 8K or earnings release, I think that could be a better way to show changes in market efficiency. And I think related to Charlie's earlier comment, I don't think it's the insiders traded themselves that make stock prices more efficient, but it's the follow-on trade. So perhaps like sophisticated investors learning from insider trading and trading in a way that makes stock prices in a timely reflection of news. So if you could do some like cross-sectional tests on like cutting based on like institutional investors or investors who are more likely to learn from insider trading, I think that could make your analysis more compelling. But just generally, I thought you could maybe improve the market efficiency part.
Okay. Thank you.
Okay, Brigham and then Rich.
Yeah, so you find that the terminations are relatively rare, descriptively.
Yes.
But you also find that it seems to be effective, that it works to terminate. And so I was just wondering what friction's going on there where you don't see more, like why it could be opportunistic, but we don't.
Why don't they more? Oh, okay.
Yeah.
I think the fact that you have to disclose that you have terminated, and that was also in the SEC's final rule, that their intention was that if you have that information out there, there's more like a monitoring going on. But as we show that the disclosure comes with significant delay, almost 80 days, so it's not perfect in restricting that opportunistic behavior. So I guess, and to talk more about like whether the rule is effective or not, we wish we would have information about the pre-period, but unfortunately we don't have that, so we don't really have a comparison about how that behavior changed. But yeah.
Rich and then Phil.
Is there some kind of background presumption here that you can increase efficiency by writing a rule? In other words, firms could voluntarily put these restrictions in place. So if it was hurting shareholders, wouldn't they? The idea is they wouldn't do it. So when these restrictions come into place, their stock prices should go up. Or the alternative was, these guys, you have you have enforcement through the courts. I think Doug and Wayne are saying, well, you don't really need a rule here because if these things are done nefariously, they'll be prosecuted. So if firms want to prevent this, they could do it voluntarily. But what's the rationale then for writing a rule? Is it distributive? We don't want small investors to be hurt? Are you assuming firms are not maximizing their values? Is that kind of the idea by adopting these things?
Is fully efficient? They're assuming the market for litigation.
I don't know. That's what well, okay. Then what we would see is we would see share prices go. Let's say this rule, because it created a presumption, there were a lot of frivolous lawsuits. So when this was initially implemented, shares of companies where there was a lot of insider trading should have gone up, right? That would be nice to check. Mm-hmm. And then it could also be the case that when this rule was announced, or at least shares might go down, because if there was a benefit on net, firms should have done this. They could have they do have restrictions to insider trading around earnings announcements already. So what is the SEC? The SEC is saying we can make things better by writing a rule even when we have private litigation, right? Is that... We can increase... Is that what because the firms are not doing what's best for shareholders? Is that...
So I'm also skeptical that the government can improve market efficiency by writing a rule.
I'm not talking about market efficiency. I'm just talking about GNP.
Right. So my strong sense is that while you're right that many firms voluntarily had these kinds of things in place, others didn't. That's in fact what the policy brief showed, that the practices in the main were to have cooling off periods, for example, but that many firms didn't. And it strikes me as possible that the market wasn't perfectly aware of the details of all those plans, especially because disclosure was voluntary in the pre-regime. And so the SEC felt, I think justifiably, that by pushing folks in that direction, they could give shareholders more transparency about what kind of trading was going on. But I want to just be clear, because there's been some back and forth about the nature of litigation here. First of all, I should say insider trading allegations as a part of litigation are often tacked on as a matter of 20A, as has been pointed out. But it's not that common a basis for actual liability. They're tacked on because the defendants hate it. They hate being accused of insider trading, even more than they hate being accused of failing to disclose material information. I think the distinction I would encourage the authors to make is between civil cases, and that's the kind of litigation that you're thinking about, and criminal litigation, which is a different matter altogether. I think until the Pizer case, it was thought that you could avoid criminal liability full stop by trading under these plans, and I presume that mattered to the individuals who were entering into the plans.
But these guys are wealthy. They don't really have limited liability. You go after these guys, you could really hurt them. Maybe adding a prison term isn't necessary to. I don't know. There are. I know Martha Stewart went. You weren't involved in that, were you?
That was not my fault. Yeah. But I just want to say, it's funny to me that I just want to push you on one more thing. I think if I have a choice between regulation by litigation or rule writing, give me rule writing, because the incentives of plaintiffs' lawyers suck, and also I think it's imprecise. It's a noisy way of going about this kind of compliance. So respectfully, I would say that if I were the SEC, may have some justification shifting away from a litigation-driven model and to one like this.
That's empirically testable.
You're right.
All right, Phil and then Bob.
So I had a version of Chloe's question added to by Christina, but so I'll just add a little bit that's left. So I remember way back when I started in Chicago, we were in 3 different buildings, and one was called Walker Museum, and Jerry had an interesting office there because it had different number of floors, and his window was at his feet. So it was always fun to go in and talk to him and see the window at his feet. He has a paper on this topic, right? I think it's your dissertation, right, on this idea that if you restrict insider trading, you're going to perhaps. So I think before you guys decide whether you would or wouldn't want to look into that, would you be adding to what we already know from 22 years ago or something like that? Yeah. So anyway, you might want to look at that paper.
Yes. That's the first. Yes.
That's all I can add.
All right, Bob and then Henry.
One thing you might want to look at, and I agree with what Robert said about the costs and what other people have said. I'm not sure you really are doing a good job with what you're claiming are costs. But one thing you might want to do is, if you looked at Bradford's thesis, which was on Rule 144, which Robert was talking about, one of the other findings in his paper is he shows that the information asymmetry in the market went down after those disclosures became public. And so you might want to look and see whether or not there's any information asymmetry impact subsequent to the adoption of the rule, especially for the group that what you call them, the adverse group, or the most likely to have done this. And I know you don't have perfect information in the pre-period, so that test is a little noisy.
Mm-hmm.
But you, as another potential benefit associated with this, it's conceivable that liquidity went up, information asymmetry went down. You might want to take a look at that as another test in the paper.
Thank you.
Henry and then Jalal.
So I am curious how culture affects all of this, but that's not really it seems clear from the discussion so far that there's a lot of uncertainty about the market efficiency side of things in the paper. As you discuss it in the paper, you pretty much go straight to measurement, which I think glosses over some important issues that could help at least the people in the room better understand what it is you're trying to do. Because there's at least 2 different ways you might mean market efficiency. You might mean that the market does a better job of processing the information that is relayed when a Form 4 is filed. So we understand better managers' incentives. That becomes a clearer signal. There's sort of, it might be similar in spirit to like a Fisher and Breccia style model where we understand incentives better, and thus we can process the signal better as investors. But and that might imply a certain kind of efficiency test that may already basically be embedded in a lot of the analysis that you already do. But the variance test seems to imply that there's some revelation of private information process that you have in mind, and somehow that is changing, or there's some way that investors are reacting to how that private information somehow gets into the market. So this is all a very long way of saying I think the reader's understanding in general, on average, of the efficiency side of things, if you choose to keep those in paper, would probably be very well served by being very clear about what exactly you mean by efficiency, and doing that before talking about how you measure it, such that the measurement matches what you mean.
Right. I guess so. We really just kind of simply focused on the direct effect of less informative trading having an effect on market efficiency, but I can see that there's can be much more going on there. Yes.
Jalal and then Ben Yos.
So my question is also related to price efficiency. So I wanted to encourage you guys to look at outsiders as well and how this affects outsider trading information collection. Specifically, information asymmetry goes down, there could be more retail trading, which you can test, and that has implication for efficiency. Also, there could be investors like hedge funds, short sellers. There could be motivated to do more trading based on bad news they can collect. So there could be a couple of things going on in addition to reduction in information just directly because of inside trading incorporated into price. Retail investors and informed investors who trade based on bad news could also change their trade.
Right. Similar to kind of how the follow-on trades from the form force. Yes.
Ben Yost and then Mark Lang.
Seil, so this is sort of related to Chloe, Christina, and Phil's point, but policy orientation of the paper, I think it would be helpful to do sort of a more comprehensive study of the costs or consequences. And so, one thing to consider is executive compensation. I was also thinking if the benefit to selling has gone down, maybe insiders engage in more share pledging. So it's a way for them to get liquidity without having to sell the shares. So it's something to look at there. The other thing is, I was struck by that cluster of sales after 90 days. Does this mean insiders are locked into their position for a few months? And if so, does that affect their decisions about the company? Are they less willing to take risks because they don't want to see the stock price drop before they can unload the shares?
About the first point, share pledging, I guess we could look at that. The second point, I really haven't thought about that, but yes, maybe there could be. We really didn't think about whether the insiders could delay information over 90 days. Like as we show in the Pfizer case, it couldn't even delay for about a week or so. But I guess there could be some incentives to take less risk throughout the period. Yeah.
Mark Lane and then Lisa Liu.
Yeah, I noticed you have the stuff in here about abusers and stuff, but I wondered whether there was an opportunity here to think through whether you could provide circumstantial evidence on who was more affected by this as sort of a way to try to tease out what the incentives might be. So you sort of have a main effect, but you don't really do much in terms of how the mix of people, for example, changes.
I'm sorry, mix in terms of?
Oh, like who is most affected in terms of characteristics of the particular executives or firms, right?
Whether like cross section of like higher ups and things.
I'm wondering like who would be most affected by this, I guess, and whether that would tell me something about what their incentives might have been.
Okay.
CEOs versus CFOs.
Yeah, something. Yeah. Okay. We could do that. Yeah. Thank you. Yeah.
Okay, Lisa and then Kathy Tran.
A very nice paper. So my understanding of your contribution is more like the policy evaluation, not at the conceptual level. And then for the policy evaluation, I think as you already very nicely acknowledged that there is a confounding event, which is the Pfizer criminal prosecution, the announcement day, which is on the March 1st, 2023, right? So the effect, then it's kind of a combination of the government regulation and market mechanism, private litigation. So currently, we cannot disentangle them. Then this may be a little bit hard to speak to the policy evaluation But related to the discussions, I thought he did a fantastic job discussing your paper. Maybe you can look at after the rule, there are some litigation cases looking at the civil litigation, criminal litigation to see what the effects there, then help to disentangle a little bit. Part of that is driven by the private litigation versus the original rule. But my guess is that the main effect is coming from the original rule, actually.
That is our argument. Regarding looking at litigation cases, I think that is interesting. I guess the litigation takes some time. So the civil litigations we try to look at regarding 10b5-1s, I haven't seen a lot of cases yet based on the 10b5-1s after in the post period. I think to do that, you'll need some more time.
Kathy and then Suhas.
I actually had a specific suggestion along the lines of Mark Lang's cross-sectional ideas, which is to look at firms based on how much their returns are driven by idiosyncratic news versus macro. So you took out industry fixed effects,
right?
But I would suspect that there are some industry effects where certain industries, their stock price is more driven by the idiosyncratic component rather than what's happening in oil prices or something like that. And so those executives, I would think, might behave differently where they need to time, or they're going to lose more on their stock trades if they don't time them. And so maybe their behavior in choosing a plan and what the cooling off period looks like, that would be different.
So some more cross-sectional variation regarding how much control you have over your stuff.
And how much idiosyncratic news there is.
Okay.
Suhas and then Ken Merkley.
So I was thinking about, if you were going to go tell the SEC about your results, and I think they'd be really encouraged by what you show them. And I also was wondering if they would say, like, okay, everything's fine, we don't need to worry about insider trading anymore, or would they ask, like, where's the insider trading now? Because in a sense, this kind of reminds me of the leasing standard where we had these bright line rules, and so companies structured their leases to make sure they didn't trigger those particular reporting regulations, but we all knew that they were still, like, economically engaged in this type of activity. So is it your sense that this rule has, like, solved the problem and we don't have insider trading anymore, or is it that they're just doing it in a different way?
That's a great question. I guess at least in our results, we see that the opportunism in 10b5-1s goes down, and also it's not like there's a huge increase in non-10b5-1 trades or opportunism there. So perhaps to actually look at this, we need to be much more creative. Maybe they do other stuff outside of insider trading to compensate for
or just
what they lost.
Of the restrictions of this amendment.
I'm sorry, I didn't understand.
Just like outside the scope of the
Right. Yeah. Yes.
Ken Merkley and then K. Ramesh.
So in Indianapolis, there's a freeway all over the city, and the speed limit's like 55, but nobody except me, of course, obeys that speed limit because they're not worried about enforcement, right?
Mm-hmm.
And so one question that kind of an assumption underlying your paper is like, what is assumed about enforcement here? And is this about enforcement, or is this just, well, now the public can see what I'm doing? I'm not really afraid of the SEC. It's just that you're showing me, like, the public can pinpoint who's abusing it. So, and you'll set me straight, I'm sure, but it just seems like with insider trading, we're always concerned that, are they really enforcing it? Is it because they don't have the resources or they can't win the cases? But it just seems like there's a lot of unenforced activity. What do you think in your paper that people are sort of thinking about on this?
Regarding enforcement, the thing I heard from people who used to work at the SEC was it was hard to go after cases when they said 10b5-1. The rule now more clarifies what can qualify as 10b5-1. So I guess I can't say that it's going to be more enforcement just because of that. And the other part was...
I mean, really, what I'm really after is how are we interpreting the result? Is it, I'm afraid of the SEC, or is it really now everybody can see in an age of social media and internet, like, this is just, I'm not really worried about the SEC coming after me. Right. Maybe it's the lawsuit or just the sort of negative publicity.
Right. I guess the mechanism we actually want to show is not that there's more, well, So there could be more market monitoring because there's more disclosure. But the effect, I think, comes from the cooling off period being mandated. So if you want protection, you have to wait 90 days. And by waiting 90 days, you have much less control over, for example, news taking out, or kind of delaying news disclosures, things like that. Yeah, yeah.
Thank you.
I just have an observation. When I saw your pre-post bar chart,
Yes.
it reminded me of the old Eric Lee's stock option backdating paper, where the graph was the opposite. Therefore, even after the rule change, some people are waiting for more than 20 days to file. Therefore, it'll be interesting to see who are the ones who are still doing in 30 days or 0 days or 60 days. What are their characteristics? Because it goes back to Rich Frankel's point. Maybe they are not about compensation; they are just crooks. Like the jar paper that talks about who have got DUI and whatever. People who get caught, they also do bad accounting stuff and bad earnings management. And the same type of thing you see here. And on the left side, I still see some white.
Right. So yeah. So we don't have full compliance. Some of the plans were grandfathered. So if you made plans right before the effective date, that would carry on, and you could have short cooling off periods. And even after, well after the effective date, we do have some observations where there are short cooling off periods. I don't know what that means, but at least some of the law professors I talked to say that if you sold within shorter cooling off periods, then you wouldn't get the legal defense. But the ones that we looked at didn't really seem to be more opportunistic than the others. Yeah.
All right, well, thank you very much to the speaker and discussant and audience.